All right, everybody. So in this video, we're going to be talking about insurance. And I've got to tell you, this is where I feel most comfortable. This is what my PhD is in. So I've talked about this sort of thing for quite some time. I'm a little impressed with how much that this book is trying to cover in this one chapter. There's an awful lot. I mean, normally I might spend close to half a semester going through these different options. But we'll do the best we can here. And again, I'm going to try to limit myself to the topics that are covered on that end of the chapter exam. So our objectives that we're talking about, health is a big risk that we all face. And when you're in good health, it's easy to take that for granted, but there's nothing that's more destructive to your human capital than being in poor health, which is something that's going to come up on one of these slides right away. So health management and health insurance in particular are fairly important, and we'll talk about how that works. People tend to undervalue both life and disability insurance. Life insurance, you have some excuse, because if you don't have dependents, then life insurance isn't terribly necessary. Disability insurance is a little bit different, because there, should you become disabled, your own economic well-being is threatened. So most people are going to have a need for disability insurance, and if they have dependents, then they certainly have a need for life insurance. So we'll talk a little bit about how those work. We'll talk about auto insurance. This is an average person's biggest source of potential liability, comes from their automobile. Should you be determined to be at fault in an auto accident, you'll be responsible for compensating the person who you've injured. And with an automobile, it's not difficult to have very high dollar claims. If you talk about somebody going to the hospital as a result of a car accident, if that accident is your fault, a $50,000 bill wouldn't be surprising. A $100,000 bill might not be surprising. And the challenge is, if you don't have high enough limits of liability insurance, you have to pay the amounts over that. So in other words, if you to be legal in the state of Indiana, a per person limit, the first number that we're looking at is $25,000, and you're legal to drive as long as you've got at least $25,000 in coverage. The problem is, should you damage somebody for more than that amount, you'd be on the hook for the difference if that's what you chose to buy. So you can be legally operating a vehicle in the state of Indiana and be dramatically underinsured. And that's true of most states. Indiana's not special in that regard, certainly at all. Most states have mandatory limits that are, in my opinion, too low. So then we'll also spend some time talking about homeowners and renters insurance, and then long-term care insurance as well. So why does a person need insurance? Well, we're trying to protect ourselves from catastrophic financial events, and some of those are easily imagined. Health exigencies. So something happens with your health, you need an extensive amount of health treatment. You all know that's very expensive in the U.S. Without private health insurance or employer-sponsored health insurance, it's going to be extremely difficult to pay those costs out of pocket. On the liability side, again, the auto is the biggest source of liability, and I just wouldn't want to see anybody have an accident and become responsible for thousands of dollars beyond their coverage limits, and then you'd have to, that'll affect you far into the future. Why do you buy homeowners insurance? Well, most people can't afford to replace their home or even a significant percentage of their possessions if it happens to get destroyed. So all of what we have in common here is we're trying to protect ourselves against financial catastrophe. When you speak specifically about health, this is an interesting slide that talks about, well, what determines your health? The two biggest factors, pay attention here, this is coming up on your end of the chapter exam here. Health behavior and genetic disposition are the two biggest factors that determine your health. So it's kind of helpful to know that you've got some control here, but it's interesting to notice that most of these things are not in your control. The majority of these are not under your control. 40% of it is. That's helpful to know. It means that good health habits will be somewhat rewarded, but it doesn't guarantee that you won't have significant healthcare expenses, and that's important to realize. That's why everybody does have a need for catastrophic health insurance. In particular, when we talk about what strategies we use for dealing with risk, a lot of times we will look at those risks in terms of how often they happen and how bad they're going to be when they do happen. So we look at them in terms of frequency, how often they happen, and severity, how bad are they going to be when they do happen. And depending on what that looks like, that tells you what technique you might want to be thinking about for handling those risks. So, for example, when we think about things that are low in frequency but high in severity, so they don't happen very often, but when they do, they're really, really bad. Those are really good candidates for insurance transfer. So the idea is you're transferring the risk. You're going to buy insurance. Now it's the insurance company's problem if you actually have a loss. You've protected yourself. You're going to pay a certain amount called a premium, and you'll be out that money, but now you're protected against possible loss if the worst should happen. So low frequency, high severity events, usually we're looking to transfer those through insurance. When we think about things that are high in frequency, they happen often, and high in severity, when they do, they're really bad. Those are behaviors that we're probably best to avoid. And that's another risk management strategy, is avoidance. So high frequency, high severity events, those are things that are prime candidates for avoidance. Then the thought is, well, what if the severity is low? So things could happen maybe frequently, maybe infrequently, but in the end, it's not terribly significant. Those risks should be retained. Sometimes people call retention self-insurance, and an insurance professor like myself will argue that those are two different things. But for the purposes of personal finance, I think it's okay to understand the idea that where severity is low, it's okay to retain those risk exposures, or to, in conventional language, to self-insure, meaning that you just accept the risk and you deal with it as it is. So when you purchase insurance, when you transfer risk, usually what happens is you're paying a cost for that. That's called a premium. There might be a portion of any losses that you have that you're expected to pay, and we call that piece a deductible. So if you get into a car accident and it's your fault and the only damage is your car, if you've purchased collision insurance, that will come along with a deductible that you choose. Maybe it's $500, maybe it's $1,000, but you will have to pay the first $500 or $1,000 of expenses related to that accident. That's the deductible, and insurance kicks in beyond that point. It's sometimes possible to have insurance structured where you make a small payment every time you use services from the insurance company. So in health insurance, particularly with an HMO, a lot of times you'll see a co-payment. And what that's just saying is every time you visit the doctor, you're going to pay $20. They put that in place to try to make it so that people don't overuse insurance benefits. And it's funny, the amount doesn't have to be very much to try to cut down on that kind of behavior. There is a group of people out there that if you make it totally free, they will consume a lot of healthcare and they'll spend their free time going to the doctor. You can stop that behavior just by imposing a very small co-payment of as low as $20 anytime you go. That's specifically a co-payment. So even though you're making an insurance claim, the insurance company is going to pay most of the cost. You might have to pay part of it. When it's a flat fee, we call that a co-payment. So insurance companies are usually specialized either in life and health insurance, that's one side of the business, or in what we call property and liability. So property liability companies sell things like homeowners insurance, auto insurance. Life and health companies, of course, sell health insurance and life insurance. And those are two very different sides of the same business of insurance. And it's interesting to watch how this has developed over the years. Most companies will focus on one of those two areas. And even the companies that handle all of those lines of insurance usually have within their companies a division of those two types of business. So it's rare for people to represent all of those types of insurance. It's usually you're either focusing on life and health or you're focusing on property and liability. So what we're trying to do with the insurance mechanism is ideally we're looking for a situation where we have risks that are low in frequency and high in severity. So from the individual perspective, this risk is something that doesn't happen very often, but if it does, it's catastrophic. So maybe a house fire that wipes out everything I own. Yeah, it's unlikely to happen, but if it does, that's going to be a catastrophe. Well, there's a whole bunch of other people out there that face exactly the same risk. And so one way to handle it is if you can get everybody to come together to share that risk. And so we all pay premiums that reflect the possibility of losses, and then whoever suffers those losses has a way to recover. That's kind of the structure of insurance, how that works. And the neat thing about it is, we don't get into this in this book, but with the law of large numbers telling us that it's easier to predict the number of losses when we have more exposures, that actually lowers the risk from the insurance company's perspective. So the more insurance they sell, the better they can predict what their losses are going to be. And for an insurance company, that's where risk exists, is the idea that the losses could be bigger than what you expected. One of the ways to mitigate against that is to sell more insurance. The more insureds you have, the more exposures you have, the easier it is to predict, and the more likely that what actually happens should be close to what you expected. That's the law of large numbers. So it's a neat function. It's a neat place to be in the economy. Insurance is interesting. Nothing happens without it. Buildings don't get built. People don't get hired. The whole economy functions because of the presence of insurance. It's absolutely a necessity. So speaking of different strategies to deal with risk, you've got two people here who are thinking about skydiving, and one of them has a tolerance that's a little bit higher than the other for risk. So one says to the other, hey, we're going to be in a plane that'll be maintained, and the parachutes have been checked by multiple people. And in that way, this person is telling the other that we think the risk is handled adequately. In the end, one of the people decides to jump, one does not. Blakely does not jump. What's her strategy, or his strategy? I guess it doesn't say. If you choose not to jump, you're avoiding the risk. You're not going skydiving. That's one way to handle the risk, is to just not do it. So in that person's mind, the risk was too high to accept. The other person did make the jump. Marty makes the jump. So he or she, what did they do? Well, that person, it's not that they transferred the risk. You can't really do that. They didn't avoid it. Avoid it would mean not jumping. And eliminating the risk, no, it's still there. So you back into this idea that the best strategy that describes what Marty did was to manage the risk. So that's just one way of looking at how, when people view risk subjectively, they can assess the exact same risk and make different decisions based on their perceptions of how likely losses are. One of the biggest insurance needs people are going to have is going to be health insurance. The unpredictability of the costs, and we know that everybody faces a potential catastrophic loss because the cost of healthcare is so high, means that trying to finance that out of pocket is probably not a good strategy for most people. Most people have a catastrophic healthcare need, and they're going to meet that with health insurance. So what that does is it helps us to manage unpredictable costs. And when you look at healthcare expenses, for most households, that's a very significant expense. We got a graph here to show a little bit. For people who are in their 20s, if you end up in the hospital, the average cost is in the neighborhood of $10,000. In my mind, that's on the low end. If you just have to go to the emergency room and you don't have to get detained overnight for treatment, that can cost $2,000. So the risk, the thing that you're worried about, you're not really worried about prescription drugs when you're in your 20s or doctor's office visits. It's rare to have a lot of those as a person in your 20s. What you're worried about is emergencies and hospitalizations, and those can add up very quickly and be very significant in terms of impacting your financial well-being. So how do we handle that? Well, we have a premium that we pay for health insurance. That's the cost of health insurance. Then when you actually seek health care, you probably still have to pay part of the cost. One of the forms will be a deductible. So it's not unusual for a person to have a policy with, say, $1,000 deductible. And what that means is your first $1,000 of healthcare expenses, no matter how it comes, maybe it takes 3 or 4 doctor visits, 3 or 4 lab visits to get there. But your first $1,000 you're paying out of pocket. That's your deductible. Maybe it only takes 1 visit to get there. You end up in the emergency room, you're probably going to hit your $1,000 deductible in a single visit. Doesn't matter if it takes 5 visits to get there or 1, first $1,000 you're paying. That's the deductible. After that, then we have a layer where we share costs. So that's coinsurance. And what will usually happen here is it'll be some percentage. 80-20 is common. So they'll say, well, you have a $1,000 deductible and then you have 80-20 coinsurance. What that means is after you've met your $1,000 deductible, 80% of your future costs are paid by the insurance company. You continue to pay 20% of those costs. And then usually it's capped at some amount. That's the out-of-pocket maximum. That's coming up on the next slide. So usually we're saying that we've got a deductible, then we've got coinsurance where you're still paying usually 20% of the cost. And then up to some amount, once you've paid a certain amount out of pocket, then the insurance kicks in and pays 100% of the point from that point forward. Some health systems and health insurance products will come, instead of coinsurance, they'll come with a copayment. And what that means is every time you visit the doctor, you pay a flat fee anytime you have a healthcare service. It's usually relatively small, so $10, $20, something like that. Sometimes you see a combination of all 3 of these things. It's common for insurance companies, for health insurers, to say that if you're going to use the emergency room and you don't get admitted to the hospital, well, then we're going to try to limit the use of the emergency room to only people who are going to be admitted. So we'll say if you went to the emergency room, you don't get admitted, there might be a $100 copay. And so that's imposed to try to make you think ahead of time, do I really need to go to the emergency room? That's a situation where you might see a deductible, coinsurance, and copayment together. That's unusual. Normally, you're either looking at deductible and coinsurance, or you're just looking at a copay. The problem on the end of the chapter exam involves all three of these things working together. So coinsurance applies up to some amount called the out-of-pocket maximum. They'll say once you've paid, maybe you got a $1,000 deductible and a $3,000 out-of-pocket maximum. Okay, well, you pay your $1,000 deductible, and then after that, any expenses you have, you pay 20% of, up until you've paid a total of $3,000, and then your responsibility ceases, and the insurance company will pick it up from there. That's an out-of-pocket maximum. So when we talk about health insurance plans, there's a couple different types that you might run into, and it's interesting. They really come from two different philosophies. So one philosophy says that, look, we're trying to keep costs down, and the best way to do that is to try to manage people's care. And the underlying theory is that, the average person doesn't really have the knowledge to effectively manage their own care. They don't know enough about medicine, about conditions, to really know what they should be doing to try to help those conditions. They need the help of a doctor anyway. So one thing that might help is, what if we try to take some control over where they're going? And a very common way to do this is to establish a network of providers that have agreed to give you a discount. So the insurance plan goes out and says, hey, we're going to try to get discounts from special providers. We will designate them as preferred providers. And then if our insureds visit these places, we will give them a discount, usually in the form of a lower coinsurance percentage. So we're trying to save money by leveraging discounts from preferred providers. And then we pass that savings on to the people who are buying health insurance, saying, if you stay within the network, you'll pay 80-20 coinsurance. So 20% after your deductible is satisfied. If you go outside the network, you'll probably have to pay a higher coinsurance percentage, maybe 60-40. That's a really common way to do it. Basically, anytime you see somebody talking about a network, that's probably a PPO plan. And they're saving money by getting discounts from people who they've designated as preferred providers. We can take a higher degree of control. That's what the HMO does. The HMO has a network, but they usually don't talk about it in those terms. What they'll say is, every time you go to the doctor, you need to visit your primary care provider first. And then that person gets to make decisions about whether or not you get to go any further. So that's the HMO. If you've heard of an HMO, you've probably heard some negative stuff, and it probably came up because the insured wanted something that the HMO said wasn't necessary. That's how an HMO works. The primary care provider makes all the decisions in terms of what health care the patient receives. So if there's ever a conflict, you can imagine that creates a problem. You don't really have that same conflict in a PPO. You go wherever you want. It's just that you might have to pay a little bit more. With the HMO, if you go outside of what has been provided for you, then you have to pay the full cost out of pocket. So you don't have insurance when you go outside the HMO's network. So it's a much tighter degree of control. It also delivers more significant cost savings. So if you're comparing an HMO plan and a PPO plan, the HMO plan is probably less expensive. One good thing about an HMO that probably doesn't get a lot of attention, most HMOs have no deductibles and no coinsurance. Instead, they have small copayments. So really, you're only paying your premium, and that's it, plus a small copayment every time you use healthcare. And again, that's a $10 thing or a $20 thing. That seems to be the way that most people would prefer to buy health insurance. People prefer to just pay a premium, and that's it. And it's the HMO that actually delivers that, at the cost of restricting your freedom. You're not allowed to get health care to make your own decisions. You have to convince your primary care provider that these things are actually needed. They have to sign off before you can get an insurance company to pay for them under this HMO model. It's what we call managed care. Both PPOs and HMOs are managed care. They're both operating under this idea that the way to save money in healthcare is to take control away from the individual. There are ways to combine that in a point of service plan, and you've got elements of both a PPO and an HMO. I honestly think that's beyond the scope of personal finance, but you've got this particular course, but you can read about this in the text if you're really interested. I do want to talk a little bit about the other way to try to save money in health insurance. And so some people say, well, we need to take control away from the individual and go with managed care plans like PPOs and HMOs. Other people say, no, the problem is that people don't pay directly for the healthcare that they consume. And because of that, they overconsume. So the way to get people to make good decisions is to make them pay for healthcare. And we can do that by expecting people to have a high deductible health plan, an HDHP. So the idea here is you are forcing people to shop around for healthcare to make good economic decisions because it's their money that they're spending because the deductibles are so high. So for a family, this type of plan might have a $5,000 deductible. That's not unusual. The first $5,000 in health expenses that your family has, you have to pay for out of pocket. Well, now all of a sudden, if that's the decision I face, now I'm going around and I'm going to shop and I'm going to ask questions. I'm going to become more informed. Where before, if somebody else is paying the bill, I don't care about any of that. So there's a group of people out there who really think this is how you're going to be able to control prices. So you got the managed care folks and the high deductible folks have kind of been at each other's throats trying to figure out which of these strategies is likely to result in cost savings. The high deductible health plans are relatively recent, really within the last 10, 15 years. We don't really have enough data to know which of those directions will ultimately result in greater cost savings. So right now it's all in the realm of theory. People arguing, hey, if you shop around, you should be spending less. I buy that, but I also buy the idea that if somebody else who's got a better grasp of knowledge in medical care is making the decisions, that should also save money. So where you fall on that spectrum probably tells us a little bit about which of those two methods you think is more likely to work. With healthcare reform starting in 2009 and ongoing, this has been going on for quite some time, and we really haven't made any final decisions about healthcare and how that's ultimately going to work from here on out. But we do have government plans that are available on the health insurance marketplace. So these are subsidized plans. Depending on your income, you might qualify for a subsidy if you're buying health insurance on your own. And here's some different types of plans that you can buy. Here's the thing. Most people are getting health insurance through their employer. Something like 80% of the population gets their health insurance through their employer. So this is really only applying to the 20% of people who have to buy health insurance on their own. Everybody who's got an employer plan, you're not dealing with the marketplace. That isn't something that's on your radar at all. One of the options that you might have, whether it's an employer plan or a plan that you buy yourself, is a health savings account plan. So these are going to be a high deductible plan. But the idea is because you have a high deductible, you have to save money to meet those expenses when they happen. One of the biggest risks you can take is choosing a plan with a low premium. See, a plan that's got a high deductible is going to have a fairly low premium. So that looks attractive. People buy those plans. But if you don't save money within those plans, then when you actually have the healthcare expenses, you're not any better off. So if you're going to go this route, you need to have a strategy set aside to actually save money to be able to meet these high deductibles when you experience healthcare costs. So one of the incentives we're going to give you is certain plans with high enough deductibles are eligible to be paired with an HSA, a health savings account. And so what happens is if you put money into this health savings account, you can save this tax-free. You can get a tax break on the money right now that you put into the plan, and then when you take money out of the plan, if it goes for qualified medical expenses, there's no taxes there either. So this is really the most tax-favored investment instrument you can find is an HSA because there's no tax on the front end. It grows tax-free, and then when you use it for medical expenses, there's no tax on the back end. Should you not experience medical expenses, then in the end, when you take money out, it will have to be taxed. And in that sense, it functions exactly like a traditional IRA. So for a lot of people, this is a very valuable tax-saving strategy. Even if you don't anticipate high degrees of medical expenses in the future. In fact, the HSA plan works best for people who are healthy and people who are in high tax brackets. And if you're both, this is your plan. This is the direction you want to go. Because to have an HSA, you got to take a high deductible. If you're relatively healthy, that shouldn't be something that scares you. Again, you're trying to look at the impact over, say, 10 years. How often are you going to hit that deductible? If you're chronically ill, you're going to hit it every single year. And then that means this is probably not the right plan for you. But if you're young and relatively healthy and you don't expect to have a lot of interaction with the healthcare system, you'll be able to set money aside. It'll grow tax-free, and then in the end, it can be a supplement to your retirement account, or it can be completely tax-free for whatever medical expenses you have. We have, at some workplaces, excuse me, you have the idea that you can put aside money for medical expenses. And what we'll do is we'll exempt that from taxation. With an FSA, the trick is you have to use your money every year or else you lose it. So with a health savings account, that money stays in there. It continues to belong to you. But with a flexible spending account, an FSA, whatever money you put aside, it's use it or lose it. So we've got a list of allowable expenses here. Most medical expenses are qualifying expenses. You're going to want to keep this list. There is a question on the end of the chapter exam that asks which of the following is an allowable expense. Well, from this list, you can see what is and what isn't. So this is something that you're going to want to hang on to. Here we have a problem that's similar to what you're going to see on the end of the chapter exam. So we have somebody who's got a health insurance policy with a $500 deductible, a $50 copayment, and an 80/20 coinsurance provision. Okay, well, if we've got $3,000 in medical expenses, you're going to pay the first $500 on your own. So we already know he pays at least $500, so A can't be right. He's got to pay a $500 deductible. There's $2,500 left to pay. There's going to be a $50 copayment that has to be paid here as well. So we're up to $550 that he has to pay. But we still have coinsurance to pay, so we know it can't be $550. So then he's paid his $500 deductible and a $50 copay. If you look what's left to pay, that comes down to $2,450 is what's left to pay, and he's got to pay 20% of that amount. If you take 20% of $2,450, you should get $490. So if you add $490 plus $500 plus $50, then you've got $990 plus $50, you've got $1,040. And yep, that's the answer for C here. So there is a problem that's very similar to that on the end of the chapter exam, and that's the process that you go through. You take what's left to pay after you've satisfied your deductible and your copay, and then the coinsurance percentage is applied to the remainder, and you add all three pieces of that up. Shifting gears a little bit, I want to talk about disability insurance. So what's disability? Well, it creates a situation where you can't continue your regular job. That's a problem in terms of lost income, and then it usually comes along with increased medical expenses, at least for a short period of time. So most disabilities people recover from, and so that income disruption is temporary. One way to deal with that is with savings. That's one of the reasons that financial planners will tell you you should set aside at least 3 months of income, 6 months is better, to cover the possibility of disability. And then that means you can self-insure. You can deal with that with your savings. What if your disability lasts longer than that? That's a risk that most people need to insure against. Should you become disabled at 25 and you can never work again, well, that's not something you can finance out of pocket no matter how wealthy you are. That's the reason that most people have a need for disability insurance, although it tends to be underbought. If you look at the probabilities of disability, they're usually kind of surprisingly high. And when you compare, everybody understands the idea of premature death, the possibility that you could die and that would create a permanent disruption to your income. And if it's just you, that's less of a financial problem than it is if you're supporting dependents. That's where the need for life insurance comes from. People tend to underestimate the probability of disability. And so this chart here just shows you every step of the way disability is more likely than premature death, especially at the older ages. And so that's something that most people will have a need for here. I mean, look at this. I find this kind of unbelievable. It's pretty rare to have people die before the age of 67. But if you look at the possibility of disability, it's like 1 in 4. It's tremendously high. So the need for disability insurance is there, even if people don't really understand that it's there. Less than half of people actually have disability coverage. That's a big problem. So when we talk about what types of disability insurance is out there, you have short-term and you have long-term. The longest short-term policy, the book says, is 12 months. I'll tell you, in the industry, 3 or 6 months is a lot more common. Anything beyond that is probably long-term disability insurance. And normally what ends up happening is we say we integrate these two things together. A person should buy both. You can get away without having a short-term disability policy if you have enough savings, right? I mean, if you saved up a year's worth of income, you could make the argument that, hey, I don't need a short-term disability policy, but you would probably need a long-term disability policy that might have a waiting period called an elimination period of 12 months. 6 months would be more common again. 6 months tends to be short-term. Although there is a question on the end of the chapter exam that says, what's the maximum short-term disability policy? And to get that one right, you're going to have to answer 12 months here. So just a note here. We've got a way to try to figure out, well, what is your disability premium going to cost? 1% of your income is typical, but you're going to want, there's options you can add to disability insurance that you're going to want to consider, and you're going to need the help of an agent. So get an actual quote. Don't just assume that that's what's going to be. But the point is that this is affordable when you think about it on a yearly basis, right? If you're talking about something that's in the neighborhood of $300 a year, well, that's $25 a month. You're going to have all kinds of bills that are $25 a month or more, right? So in the context of your entire financial well-being, this is not unaffordable, and it's something that you're going to want to consider. The real advantage of disability insurance is that it doesn't depend on how you get injured. Lots of people have workers' compensation coverage. Your employer is required to compensate people who get injured on the job, and that's by law. So if your disability comes from a work-related incident, you'll have disability coverage. But disability insurance in the private market covers everything. And so it doesn't matter how you get hurt or if you get sick, you'd be able to collect benefits to replace your income. And that's really important because there's all kinds of things, particularly on the illness side, that aren't going to be work-related. I think that's one of the tricky parts. People say, well, if I'm physically injured, that's most likely to happen at work. I'm covered from workers' comp. I don't need disability insurance. If that's how it happens, you're right. But disability insurance protects you regardless of where the incident occurs. And it's because of that, particularly for illness, that a person needs to consider disability insurance. So shifting gears a little bit, talking about life insurance. Life insurance pays a benefit called a death benefit to a beneficiary. That's somebody, if you're the owner of the policy and it's a policy on your life, you name the beneficiary and you're flat out saying you're buying a specific amount of coverage that the beneficiary will receive in the event of your death. It can be paid out as a lump sum. That's usually how it's thought of. You can stretch those payments out over time if you prefer, but that's usually what you're thinking about. The owner is the person who pays premiums, and then ownership rights come along with that. So whoever is the owner of the policy can name the beneficiary and so forth. The insured is the person whose life is insured. We pay a death benefit when that person dies, and we pay that benefit to the beneficiary. And that person is named by the owner. Most of the time, the owner and the insured are going to be the same person. I buy insurance on my life. That's 90% of life insurance purchases look like that. But there's other people I could buy life insurance on. I could buy life insurance on my spouse, assuming my spouse agrees. And then I'm the owner, but my spouse is the insured. Well, I'm the owner. I'm the one who gets to make all the decisions about beneficiaries there. So it is possible to separate the owner from the insured, although that's unusual. And it's the owner who decides who the beneficiary is going to be. Here's the thing. There's only two types of insurance. There's a whole bunch of subtypes of life insurance, but there's really only two main types. One type is term insurance. Term insurance is temporary. So what's happening here is you've got a specific coverage period that you've identified, and if a person dies within that time, then a death benefit is paid to the beneficiary. If the person survives to the end of the term, then they can renew for another term up to a certain age. Once you get to age 65 or 70, you'll find that life insurance companies don't sell policies anymore because they're too expensive. So if you're buying coverage on a term basis, you won't be able to renew past a certain age. But for everybody else, you can continue to renew until you reach that age. So most people are going to survive to the end of their term life insurance policy, right? Let's say you're 25 years old, you buy a 30-year term policy that covers you until you're 55. Well, it's rare for people to die before the age of 55. It can happen. It's not unheard of, but it's rare. And because it's rare, you don't have very many losses. And because there aren't very many losses, the premiums tend to be relatively inexpensive. So if money's tight and you're trying to figure out how you're going to afford life insurance coverage, term is the way to start. If, on the other hand, you are concerned that beyond the age of 65 or 70 that you would still have a life insurance need and you want to make sure you get a death benefit that gets paid. So if you have a permanent life insurance need, not just a temporary need, right? What's a temporary need? Well, all right, maybe I want to protect my children until they're on their own. Let's say my youngest child is 5 and I expect them to be on their own at the age of 25 and independent. That means if I buy a 20-year term policy, if they really do over the next 20 years develop independence, then I only need a term policy to handle that temporary need. And then after the policy expires, I let it go because I don't need it anymore, for the protection has taken place already. Sometimes you don't have that. Sometimes you have permanent needs. There's a couple different places that happens. What if you have a child who's never going to be independent? That's a permanent need, and you can't meet that with term insurance because eventually it expires and eventually you get too old to renew. It's too expensive. So if you have a permanent need, then you have to look at permanent insurance policies. So what's happening here is the way we finance that is you're overfunding. You have to overpay in the early years to be able to provide permanent protection. And that's the only way to do it. You're overpaying in the early years, and because you're overpaying, part of it is going to pay for life insurance protection, but the rest is actually functioning as a savings account. And you need that savings account because should you reach that age of 65 or 70 where those term premiums get really expensive, now you got a savings account to help you pay for that. So you're blending those two things together. Here's the thing, in a permanent life insurance policy, there will be a death benefit paid. They're priced as if a person's going to live to the age of 100. And actually, if you reach the age of 100 and you haven't died, they'll make the death benefit payment to you. So there is going to be a death benefit received. So most term policies expire unused because most people survive to the end of the term, and that's why they're cheap. All permanent policies, if they're kept in force, will be paying a death benefit. And so those premiums are going to be a lot more expensive. So it's not enough to say they're more expensive than term policies. They're a lot more expensive. For a young person, you might be able to get, say, $500,000 in term coverage if you were healthy for, say, $300 a year. That equivalent amount of permanent life insurance that lasts for your whole life, that might cost you $3,000 a year. So a factor of 10 for somebody who's 25 in terms of price differential on life insurance. That wouldn't surprise me at all. Then you've got this money that you've been overpaying if you've chosen a permanent life insurance policy. And the savings part we call cash value. So you can invest that cash value in some types of permanent life insurance policies. And this is a good outline here of what's going on. So if you are wanting a fixed return, ordinary whole life insurance is a permanent policy that has cash value that will provide you that. And then it'll show you what your cash value is going to look like, and it's guaranteed. So we can predict it out into the future. I can tell you in year 23 how much cash value you're going to have because it's predictable. Universal life all of a sudden, well, let me back up. Let me go to variable first. So with variable life insurance, you're taking that cash value and you're allowed to invest that. So you're hoping to beat this guaranteed fixed return that you get with whole life insurance. Universal life insurance introduces the idea that maybe you need flexibility in paying your premiums. So normally the way a cash value policy is priced, a permanent policy, you're paying that premium every month, every quarter, every year, whatever you've decided, but you're supposed to pay that for the rest of your life. And again, it's expensive. So because of that, there may come a year where you just have a lot of expenses and you're not able to afford to pay your permanent life insurance policy premium. Well, if you have a universal option selected, what that allows you to do is stagger those premium payments. In a bad year, maybe you don't pay anything at all. In a good year, you might overfund it and pay even more than what the predicted premium was going to be. And if you're ever going to underpay, well, you'll have to make that up at some point in the future, or else the policy will not last for your whole life. So the idea of variable life insurance, that allows you to invest your cash value. Universal life insurance gives you flexible policy premium payments, and you have a little bit of control over how much do you want to pay this year versus next year versus 5 years from now. Although if you ever underpay, you have to make it up at some point in the future or your policy will not last for your entire life. When you combine those two things together, you get variable universal life. And that means you've got flexible premium payments. That comes from universal. And then you're also able to invest your cash value, and that comes from the term variable. Okay, so two types of life insurance. Term is temporary, lasts for a specific period of time. If you die within that specific period of time, your beneficiary gets a death benefit. If you want permanent life insurance, that lasts for your whole life. Because it lasts for your whole life, the only way to finance that is to overpay the early premiums. And because you're substantially overpaying those, that's creating cash value. That's savings within the life insurance policy. And if you care about the ability to invest that cash value so that you can watch it grow, that's something that you can elect in the form of a variable policy. If you're concerned about the ability to pay premiums in the future, then maybe you want the universal option as well. So those are your two main types of insurance, are term life insurance and permanent life insurance. A lot of subtypes, and that's where confusion comes in, but there's two types of life insurance, and we start there. Okay, so who needs life insurance? Well, it really is a function of, do you have dependents or not? If you're a single person, no dependents, you can make the argument that you really don't need life insurance. Because if your income stops, that primarily impacts you, but you're gone. It's a much bigger problem when you have dependents. So spouse and children typically, or anybody else who relies on you for income, they're threatened if your life ends, because that means your income ends. And that's going to result in them having to reduce their standard of living unless you've purchased life insurance. So, all right, you get to the decision, you say, yeah, I guess I have dependents, I have a life insurance need. How much do I need? How do I figure that out? Well, there's simple ways to do it. There's an income multiplier. So some people say, well, hey, if you've got 10 times your income, that sounds like enough life insurance. That's going to depend on your situation. I mean, if you've got 10 times your income, it sounds to me like that would take care of your family if something happened to you for 10 years. If you have especially young children and you're young yourself and your spouse is young, 10 years might not be enough. It wouldn't be unusual for a young family to come into a life insurance office and say, look, I want to provide for my family. How much do I need? And for them to say, well, the median income in the U.S. is a touch over $50,000 a year right now. So let's say you wanted to have an average standard of living for your family, $50,000 a year, and you want to provide that for 20 years. Hey, guess what? Just off the top of my head, if I'm just multiplying that out, that's $1 million. You're not going to surprise anybody if you say I have $1 million life insurance need if you're a young family. In fact, an agent might say that actually doesn't sound like enough, depending on the standard of living that you're trying to provide. There's a couple other ways to do it. We can look at your actual needs. And that's a useful conversation to have. Are you interested in paying off your mortgage? Are you trying to provide enough funds for your children to go to college? If those are goals of yours, those amounts have to be reflected in the life insurance amount that you choose. Another way to try to do it is to look at, well, what's actually lost? And that's just a time value of money calculation. If I make $40,000 a year, my family after taxes maybe ends up with $30,000 of that. So the loss to my family is $30,000 a year. Right now, maybe I'm 30 years old, and so I would want to provide $30,000 a year until I would have been 65. So that's a 35-year need. Okay, well, time value of money. I need $30,000 a year for 35 years, and I need a sum of money today that will let me buy that. So now we have to make an estimation on what you could invest money at. Once you've done that, that's all you need. It's just the present value of an annuity, right? So that's the human life value approach. I think on the end of the chapter exam, they have a problem that looks a lot like this. So they say, oh, well, using the income multiplier estimation method, that just means multiply your annual income by 10. So how much life insurance would you need if your current income is $45,000? Multiply it by 10, it's $450,000. Fairly simple and straightforward. The other two ways of calculating are more difficult, but more valuable too, because then they're tailored to your actual situation. Okay, so want to switch gears to auto insurance. And the biggest reason a person needs auto insurance is to protect against the possibility that you could hurt someone else. Also to protect against physical damage that you do to their automobile, but those amounts are capped at the value of the vehicle. That would be the worst case scenario, right? When you hurt somebody, those amounts could potentially be very, very high. And so that's what we're primarily worried about. And then you can purchase insurance on your own vehicle should you get into an accident where it's your fault and you've damaged your own vehicle. That's collision and other than collision coverage. When we talk about liability coverage, it's really common to see a split limit. And it'll look like this, 25, 50, 10, and those numbers are in thousands. Actually, this is Indiana's limit as well. So what's required apparently in Missouri too, I didn't know that, But same as in Indiana, that first number talks about the maximum amount that they'll pay to any single individual that you cause bodily injury to. So medical expenses to somebody else. 25,000 is the max. If you've bought this limit, that's 25,000. You can buy a much higher limit, and in fact, I would recommend that you do. You'll find it's really not that much more expensive to get massive amounts of liability coverage because it's rare to cause those kinds of accidents. But the whole point is to protect yourself against catastrophe. And honestly, if you're buying these limits, I'm going to make the argument that that's too low. It's an opinion, but I don't want to see anybody cause more damage than this and be personally liable, on the hook yourself. If this is what you bought, they'll only pay $25,000 to anybody for medical expenses to any one person, and they won't pay more than this amount in the middle, $50,000 in total for bodily injury, no matter how many people you hurt. Then $10,000 refers to property damage that you cause. So if this is the limit that you bought, I'm going to argue you're undercovered because of this. And maybe if you don't buy it there, you'll buy it here. You'd have a maximum of $10,000 available to pay for property damage that you do. I don't know. Do you know anybody who has a vehicle that's worth more than $10,000? Because if you hit them and you total it out, you won't have enough to fully cover the cost, and you'll be personally on the hook for the rest. These limits are the legal limits. You got to have at least that to be able to drive. In all states, I would argue they're too low. So those are split limits, and those are how they work. We've got a good list here of things that impact your premiums for the future, and there is a question on the end of the chapter exam that talks about what are the premium factors. So keep this list in mind. So I don't know, this really should not have the word liability on this slide that's provided by the textbook here, because this is first party coverage. This is paying for my damage to my car. With collision, that pays for impact with an object or upset of the covered auto. So if I turn my car over, single car accident, or if I impact an object and it damages my car, well, I'm at fault. So I'm not able to sue anybody else to recover. I have to cover this on my own. I can either pay out of pocket or I can buy collision and comprehensive coverage. Collision pays for impact with objects and for upset of the covered vehicle. Comprehensive pays for all the other kinds of losses that aren't collisions. So hailstorm, that's a good example. Theft, that's a good one. Broken windshield, something like that. If that's not the result of an impact with an object, then it doesn't come under collision. It comes under comprehensive. You could buy one and not the other. That's unusual. People usually either buy both or they don't buy it at all. The only people who are not buying this are people who have accepted this risk. They're self-insuring. They're retaining the loss. They're saying, if I damage my own car to the point where it's totaled, it's unrepairable, it's not worth fixing, then I'll just replace the vehicle out of pocket. If you can afford to do that, that's probably what you've chosen to do. If you can't afford to do that, you've probably purchased both of these coverages. Some of these things, if you're interested in them, you can read about them in the book. These are smaller coverages, but sometimes critically important. What if somebody hits you? By law, they're supposed to have auto coverage. What if they don't? Well, then you will be able to sue them and you'll win a judgment, but what if they can't pay it because they don't have any assets? Usually people who can't afford auto insurance don't have a lot of assets to pay claims that they're responsible for. So the problem that you have is, you'll be able to win a judgment, you just won't be able to collect payment. And so you can cover that risk yourself with uninsured motorist and underinsured motorist coverage. Again, you're usually either buying both or neither. So the idea is that should somebody hit you and they don't have insurance, your coverage, if you bought uninsured motorist, will step in to fill that problem. It can happen on the collision and comprehensive side that your car is worth, you owe more than what your car is worth. Your car is worth less than what you owe on it. Well, that creates a gap. And it's possible, usually when you're financing your car, to purchase gap insurance, and that's what that does. It says if you owe more on your car than it's worth, normally we're only going to pay what it's worth, and that's the maximum payment you can get. If you purchase gap coverage, we'll also cover the difference between what it's worth and what you owe. And a lot of times that's wrapped into the financing of the vehicle, and you might have it and you don't even know it. There's a good slide here that talks about what to do and what not to do with a car accident. Doubling back to make sure that we hit something that's coming up on that end of the chapter exam. The 50 in a 50, 125, notice these are higher limits than what we were talking about. The first number is always the most that they'll pay for bodily injury liability to a single person. So it looks like to me the right answer here would be D, medical coverage for one person in the other car. This is liability coverage, so it's paying other people. 100 is the most we'll pay in total for bodily injury, for medical expenses to other people. And then 25 here, this is for property damage. This is a little bit better property damage coverage because you got fewer vehicles that are going to be worth more than that you could damage and be liable for. So here we're talking about property and liability coverage, mostly property here when we think about homeowners and renters. So yeah, perils are things that cause losses. Hazards are things that make losses more likely. So yeah, windstorm is a peril, and living in a place where windstorms are more likely would be considered a hazard. That's fair. When we talk about homeowners, yep, we got coverages A through F. A is going to be the big one. That's damage to your dwelling. B covers other structures. C is a big one because it's the rest of your personal property. It's your stuff. So A is the biggest because that's going to repair your house if something happens. C is probably the second biggest because we're worried about your personal property. And then we've got some other payments that show up. E can be big because this provides you a little bit of liability coverage in case somebody gets hurt on your property or someone should try to sue you for some other covered loss. Your homeowner's policy does provide you some liability coverage. It's worth thinking about what you own and working with an agent to try to figure out if there are things that you own that require special coverages. So in a homeowner's policy, there's a bunch of property that is limited. And if you have any of those types of property, buying a floater policy or an endorsement is something that you might be able to get extra coverage added to your policy. You're going to need your agent's help to figure out what those things are. If you want to be able to get higher amounts of liability coverage, this will cover both your auto and your homeowner's liability when we buy what's called an umbrella. So this is excess liability coverage on top of the limits that you have in your auto policy and your homeowner's policy. And that's something that's worth considering for sure. The umbrella sits over your personal auto policy and your homeowner's policy because you got provided liability there. If you don't own a home, you still might want to insure your possessions, and the best way to do that is through renter's insurance. Renter's insurance is relatively inexpensive. I would say definitely on the lower end of this is what you could expect to see. And yeah, anytime you're buying insurance, you want to buy it from the same company because you might be able to get multiple discounts when you do that. The thing about renter's insurance, people usually say, well, I don't need renter's coverage because I really don't own anything that's valuable. You know, the most valuable thing I own is maybe my computer, and I could replace that out of pocket if something happened. I understand the thought process. The challenge is, what if you lost everything? Everything you own. I'm guessing now that all of a sudden that's a problem. Even something like your clothes. What if you lost all of your clothes? What would it cost to replace your wardrobe? I'm guessing you can't really do that for $500. I'm guessing that and that's just your clothes piece of it, if you lost everything. But what if you just lost everything that was in your bathroom? I don't know if you'd be able to replace that for a couple $100. And again, we're worried about what if we lose everything. People sometimes think their landlord will cover the loss to their property. In general, they won't. Landlords are normally insulated from liability here, even if the loss is caused by something that they did. So to protect your property, you really do need renter's insurance. And the good news is it's cheap. You're talking about something that's in the neighborhood of $10, $20 a month at the most. That's affordable. That's something that's worth considering. You also get some liability coverage with renter's insurance, and that's worth having too. That's helpful. I want to shift gears again and talk a little bit about long-term care. So you're talking about people, usually older people, but not always. But if you're unable to perform 2 of 6 identified activities of daily living, ADLs, if you can't do that on a regular basis, you might need long-term care. What's an ADL? One would be being able to transfer from a bed to a chair. Can you do that by yourself? Can you feed yourself? That's an ADL. Are you able to maintain continence? Do you need assistance when using the restroom? If you don't, then you don't meet that ADL requirement. If you did, that's an ADL. So there's 6 of these, and it's not important to memorize them. But this is a situation where we say if you can't do 2 of these things, you probably need help. You probably need long-term personal care, and that's not covered by health insurance. So that's the problem. It's expensive to hire long-term care. So even if you've got somebody coming into your house, that's going to be less expensive than full-blown nursing care, but it's still going to be fairly expensive to deal with that. So one way to handle that is to buy long-term care insurance. And when you do that, you can get any help that you need in a facility. And a lot of times that's going to be a nursing home, assisted living place, something like that, but it'll also pay for home care. And the thought is, well, hey, if we can keep people in their homes, that's probably less expensive. So where we can do that, we want to do that. Long-term care generally doesn't cover all the costs of care. It's paying people to help you with the personal care needs that you have. So who provides long-term care? You can buy long-term care insurance on the private market. If your assets are low enough, you can qualify for Medicaid. But the only people who qualify for Medicaid have to have limited income and limited assets. So if your assets and your income are low enough, long-term care can be covered through Medicaid. Medicare does not cover very much in the way of long-term care expenses. Medicare is mostly paying for health expenses for people who are over 65, remember. Also, health insurance, again, is not going to pay for long-term care. So Medicaid is a program that will, as long as you have assets low enough. So one of the strategies that people use, if you need long-term care, if you spend down your assets, maybe you can qualify for Medicaid. And that's an interesting choice to have to make, but there's a lot of people who do that. Otherwise, you have to pay for that on the private market yourself, and it's extremely expensive. So here's the slide that just shows some of the people who are involved with long-term care. This is a really interesting thing. Most people don't think about long-term care until they have parents who are going through this. So it's rare for people in their 20s and 30s to be thinking about purchasing long-term care insurance for themselves. Much more common in the 40s and 50s because people start to see their parents going through this, and they start to say, oh, wow, yeah, if this is likely to happen to me too, what would I want? And you certainly have a lot more options if you have long-term care insurance, or at least a strategy to pay for long-term care. That's something that is a significant financial need that, because it doesn't come up until later in life, sometimes gets ignored, and that causes problems. All right, so I tried to highlight some of the things that you're going to encounter on this end of the chapter exam. If you've watched all this and you've read all the material, I'd say you're probably pretty well prepared for that. So go for it. Let's do that end of the chapter exam. Good luck, and we'll see you next time.